So welcome to episode 4, and in this episode we're going to talk about the capital gains tax. The capital gains tax is a really important tax that applies to many different transactions. But today we're going to focus a little bit on CGT, housing affordability, and on some of the options for reform that might be coming up in the budget, but also reform in general when it comes to capital gains tax. So again, I've got Alex with me. Welcome, Alex.
Thank you, Venkat.
We've got a lot to talk about here, and we're going to try and keep this one short, as I said, because this is a topic that we can easily talk about for years on end. But it's always worth, I think, starting to talk about CGT and the history of CGT and what it was like when it was first introduced as of the 20th of September 1985. And just talk a little bit about, I think, what the design of the original CGT was, because we've forgotten what it was.
Yep. Thanks, Venkat. So when capital gains was introduced by the Labor government back in 20 September 1985, the original plan was to have this thing called indexation. And what the proposal was that if every taxpayer owned a property or asset for more than 12 months and then they disposed of it and they made a capital gain, they could index the cost for inflation from the quarter of purchase to the quarter of sale. So that allowed you to tax only what we call real gains, adjusting for inflation. So that was the original intention. Right? But again, and that's where I think this 12-month issue came about, because the original system was hold for at least 12 months, make a capital gain. Doesn't matter whether you're an individual, company, trust, whatever, you got the benefit of this indexation. So that was the original system. Yeah.
And it's worth then just emphasizing on that point that indexation was available to all type of entities of taxpayers. It wasn't just limited to individuals.
Yeah, that's right. Yeah.
But things changed in 1999, didn't they?
That's right. And then on the 21st of September 1999, now September each year didn't have any real meaning other than that was the date of the federal budget. That's all.
Right.
Now the May, so any change will be from May. So September was the original month that the budget was introduced by the federal government back then.
Oh, okay. Yep.
So in September 1999, the Liberal government came to power, and they said, let's get rid of this indexation method. Okay, let's just have a simple system, but we'll keep it and limit it to certain types of taxpayers. And that was human beings or persons. So whether you're an individual or a partnership, but if you're human beings, then again, as long as you held for more than 12 months, as long as you made a capital gain, okay, and it was disposed of after the 21st of September 1999, you would now use the 50% discount rule. That was it. But to complicate matters, assets bought between 1985 September and September 1999 and sold after September 1999, you could choose either of those methods. But we complicated it further by freezing the indexation up to the change in the law. So you'll see that if later on we talk about reform, you can reform things, but the way they reform things is not a simple way. They just like overly complicated, which in a sense is good for the future accountants.
Well, that's right, because I guess to some extent you can't apply legislation retrospectively, because that would also be unfair. So you'd have to have some kind of provision to deal with people who've already made decisions in the past, whose effects will be felt in the future. But I guess just for the listeners, it's worth just pointing out what this 50% discount thing that we're talking about is, right? So if let's say you make a $100 gain, so you buy something for $300, you sell it for $200, you make a $100 gain. Half of that will be tax-free, and the other half you just pay tax on as you would pay tax on your income. So that's that discount. And really, one of the big criticisms of the discount is that it's been very useful for high income or wealthy individuals, because they are the ones who typically, not always, have more access to assets, and therefore they're benefiting from this. And again, just to re-emphasize, companies can't claim the discount. It's only available to individual taxpayers or human being taxpayers.
So back in the early 80s and even beyond, people had investment companies. So they had companies that were formed to hold investments, because this concept of separate legal liability and all those things. And then as things evolved with this change where, indexation was fine, but from September 1999, when they saw this discount rule apply, then companies holding investments where you're going to dispose of them after 12 months didn't attract the discount. So a lot of people
No.
said, okay, let's have it owned by a company as trustee for a trust.
Yes.
Because a trust is different to a company. And holding a trust, as long as you do a distribution of the gain to a natural person, then that natural person got the benefit of the discount. So we could overcome it in some ways. Okay, and again, that's one of the reasons why the government itself hates the concept of trusts as well.
Well, and I guess this is a perennial problem, right? You create a set of rules and then people find loopholes around them. And then you find a sort of patchwork quilted rules on top of those to try and circumvent the gaps that people have found and so on. But look, that's something that you're going to get with any system. It's not just the tax system. You get that with cybersecurity as well. You build a website, someone's going to try and hack it. And then you try and patch it, they'll find a way around. So I guess what we should talk a little bit more about now is that CGT, at least in terms of what the general public's exposure to CGT or capital gains tax is to do with this discount. And it's to do with the fact that you would say that people negatively gear their properties. And and they still get a discount at the end of that period when they sell the property, which is why it's been pushing up investment property prices and so on and so forth. So let's just give a quick 1-minute summary of what this negative gearing and capital gains tax relationship is, Alex.
Yeah. Okay, so when you look at it, I think you'll remember there are two sides. There's the asset, which is about capital gains, and there's the income side, which is about the concept of negative gearing. And the two sort of go together, because if we start off with the simple view, if you want to buy an investment property, say, or an investment, if you don't have the money, you've got to borrow the money. Now, tax law says, like, if the interest cost is related to earning the income from that investment, then the interest cost is deductible. Now, negative gearing just really means that the costs of the investment, the interest costs, the rates, the insurance, etc., if they are greater than the income, that difference is the allowable deduction. That difference being a loss is what we call negative gearing. So gearing just means that the cost of borrowing is greater than the income produced.
Although it includes a whole bunch of other costs as well. So so basically, if you so essentially, if you're running you buy an investment property, you run it at a loss in a nutshell, I guess. But you've pointed out all the more specific details. So that's the negative gearing. That's the income aspect.
Correct. Yeah.
Now
so
the asset.
So if you go just first off on the income side, Venkat. So if you're looking from the income side, that loss, if you like, is a deduction. So that reduces your income tax payable. And for most people, if you're salary and wage earners, then your employer's deducting tax on your gross wages. But because you get the deduction, it reduces your gross wages. So effectively, you get a refund. So the refund plus your rent is what's funding the shortfall, but it doesn't fund all of it. Because if you look at it financially, you're an idiot if you negatively gear.
Yeah.
Because you lose money, right?
Exactly, because it's still cash that you've got to pay for.
Yeah, correct. But there's the kicker that comes in on the other side about the capital. And that's why the two are related. So if you can bear the income cost, if you like, the payback for you is when you dispose of it. Now, if you dispose of the asset, that's when this capital gains and this discount issue comes into effect. Plus, if you dispose of it when your income's lower, so in other words, you're retired or part-time working, you're only paying tax on half of the gain on the capital, plus you're paying hopefully at a lower tax rate. And that was how the two things worked together. But that was driven by the fact that the asset you've got always goes up in value.
That's always been the assumption, right? And I guess with property in Australia, real estate property in Australia, that has certainly held true for the last 20 to 30 years, right? Where people, especially in Sydney and Melbourne, people have become millionaires just off the back of having owned a house, which they might have purchased for, very little money.
That's right. That's right. And that's why we, the issue is about, that people have made money on the capital. And, it's sort of, the focus has always been on the property, not on, you could do exactly this concept of gearing with equities, managed funds.
Yeah.
But because they're more volatile in the sense of that you see the price every day, you worry more about it. But remember, with property, there's no record that says your property price today is $10 or $100 and tomorrow it's $120, because you don't value it until, you look at your annual rates notice to give you an indication.
Yes,
or
so it's a
valuation. Yeah.
it's
So
not speculative, whereas shares and equity are much more
correct,
speculative. So
correct,
and you've got a genuine downside risk there as well, because if the stock market goes down, if there's a war
yes,
somewhere,
yes,
then
yes,
it changes. So the value of your asset changes. Whereas housing tends to be a lot more stable.
correct,
It just
correct.
and Australia at least, it's been very stable and
Yeah, yeah.
increasing over the last 30 years.
That's right.
The
And yeah, that's right. And I think you take the simple scenario that if you and me, Venkat, owned $1 million of shares, hang on, at the end of the day, you and me have to live somewhere.
Yes,
And that's the view
exactly,
that people take, that people could be multi-millionaires, but you got to live in a house.
exactly.
So that's why people gravitate to properties. They can see it, they can touch it, all these emotional things. And,
Well, and property to some extent, you could argue, is close to a human right. Like, I mean, a shelter is a human right, should be a human right, should be treated
yeah,
that way. But that's a
yeah,
separate
yeah,
rabbit hole that we won't explore
yeah,
today.
yeah, correct.
But just to finish off that example about
Yes,
the negative gearing, right? So
yes, yeah,
not only when you're older and retired, you might have less income, therefore you're on a lower rate. If the
yes,
property was owned by, let's say, you and your partner, right,
yes,
then
yes,
essentially that 50% discount is almost a 75% discount,
correct.
because
Yeah,
the
yeah,
two of you
yeah,
jointly owning it, only half of that
correct,
gain is taxed in each person's hand.
correct.
So it can be
Yeah.
really quite a significant sweetener when you dispose
Correct.
of the asset. And that's
Yeah,
the thing that people are saying is creating an unfair advantage,
yeah,
right?
that's
So the
right.
negative
Yeah.
gearing, no one's really saying that's creating a negative advantage. It does
No,
give those people who are negative gearing, it does give them a slight tax advantage. But as we've
correct.
just discussed, you're still out of pocket, possibly
Yeah,
several
yeah,
$1,000s a month. So it's
correct.
not a small
Yeah,
amount of money that you've got to sacrifice in the short
correct.
term.
Yeah. And I think
For
people
that,
remember too that, with the way the economy in the world is, that people borrowing to buy things, the theory's always been, Venkat, when you and me get to 60 plus, we should have cleared all our debts. But now
yes,
the price is people in their 60s won't clear their debts.
nowhere near.
So they're all
In
going to
fact,
be,
there's yeah. In fact, people. The estimate now, I think, is generally most people who buy a house today will be
yes,
lucky to clear it by the time they're 70,
correct,
right?
correct. Yeah, so,
And that's got implications for all sorts of
correct,
social security and all
correct.
the rest
Yeah,
of it. Um,
yes, yeah,
so I guess to sum up where we're up to at this point, right?
yeah,
We've got this problem, I guess, with CGT, where it has effectively created certain incentives in the market, particularly the
yes,
real estate property market,
yes,
that people would argue has led to outcomes such as increased property prices or whatever. So
yes,
the government's now at the moment talking about reforming this. So when we
yes,
talk about reform, let's talk about some of the options. Now, the main one that's been discussed
yeah,
is the discount.
correct.
So what are the main options that they're looking at the moment? And let's see if we can come up with some ideas.
I think a lot of the commentary in newspaper about is, okay, get rid of the discount, drop it to
Mm,
zero, or do we have the discount at half what it is, say to 25,
mm,
or to possibly have it the same rate that we apply to superannuation funds, which is a 33 and a third percent discount.
that's right.
So the government's got a range of options, and you look at the politics. They might be saying, yes, we want to reform, but
Mm,
we're not going to do a big leap and cut it to zero. I think they'll either bring it back to possibly the same as a superannuation fund.
mm.
So at least we've got a consistent rate across the board rather than currently the two rates that we have now. And I think that's probably one of the options more likely to come out of the budget in May.
I think
The other
so.
option, I guess, is
Mm,
look at the time frame. There's 12. What's so magic about 12 months?
mm,
If you think about with property, given the current environment, 12 months you're never going to make a gain now, way the market is.
mm, mm.
And should we start off with the same, make it 5 years or 10 years before you can get the discount?
Yeah, well, that's another
If you
option,
make
that,
holding
isn't it?
longer, which
Mm,
means people, if you're holding investment products where you're renting them out, the person knows that this product's got to be held for 5, 10 years, so at least it's still
mm.
generating rental income, etc., rather than sort of this quick flip. So I think
Yeah.
should look at the economy as
Mm,
well in
mm.
deciding whether 12 months is it realistic or not. I don't think it really is.
Yeah, I mean, I guess the 12 months was put in place just to stop speculative share trading,
Yeah,
and
yeah,
people
yeah,
using,
yeah.
who might be buying and
Correct,
selling a couple
correct.
of days
Yeah,
and making a bit of
yeah,
money,
yeah,
so that they weren't able to access the discount.
yeah.
So I guess
But
that's
I
another
think,
important point, isn't it? That
yeah. But I
what's the
think the
time frame?
if you think about it, when you buy and sell, it's bloody expensive now.
Yeah.
Scams. these things. So you're not going to flip it as quickly as possible. And I think
No.
was possibly about people that did buy, old houses, do them up and sell them and all this sort of stuff. But that means they're more probably a business than capital gains issue. And I think also that, the only time you flip within 12 months or quickly is probably the equity market.
Yeah.
So I think, we need to look at the type of asset to look at this time frame, and maybe we have, simply Venkat, a segregation of, for equities, it's 12 months, for other property, other asset types, it's longer. Possibly.
Yeah, whether it's, that's the thing, right? It's that if we start to use a different system for, say, residential real estate versus all other CGT assets, that might be one option. Now, some people would say, well, you can't do that. It's going to complicate things too much. But at the end of the day, that's the problem you're trying to solve. So in one sense, it makes sense to say, look, let's just focus on that being the problem, because it's hardly the case. It's hardly the case that people are suddenly going to, like we said before, you still need a house to live in. So, it's not like people are going to abandon housing and run towards equity. It just won't happen. So there's two things. One is the rate. The rate can be changed to whatever from what it is now. It obviously won't go up. It's got to go down. So that's one aspect. Another aspect is, how long do we allow the holding of the assets? That's one other issue. And I think what we probably is not so clear from the public debate is that if we did get rid of discounting, why not bring back indexation? Why not allow people to increase the cost of their asset, the cost of the capital asset, by inflation? And while it's, it's an unfortunate complication to the system, it does bring a certain amount of fairness to it, doesn't it?
Correct. I think because the whole idea, when you look at a dollar today is not with a dollar in the future. So we do allow for inflation in just normal economic sense. So it would make sense to say, look, go back to the original concept and just have indexation. And maybe, as if you do that, change the time frame. Don't make it 12 months, make it 2 years, whatever.
Yeah.
So at least you force people to hold longer. And it may also help address this issue, because a lot of the commentary has been about, landlords are getting out, selling the assets because they're worried about changes to the rules and all this, and the cost of property is high. But if you change the time frame, maybe they hold longer, then there's a bit more certainty in the rental property market, possibly.
Yeah, definitely. And actually, one of the things that is a characteristic of Australia's rental market, which is very different to other countries, is that here rental is very unstable. You could sign a 1-year lease, and 9 months later the owner says, "I'm selling up, move out." Whereas in other countries, you could sign very long-term leases, 5 years, 10 years, and in many countries, once you rent a property, and as long as you're paying the rent, the landlord's happy. They leave you there. So I think changing the discount will have an effect on that, you see. And I think that's the part of the equation that we're not perhaps considering, is that rental is good. You want rental supply, but you also want stability in rental supply for the tenant as much as for the landlord, Now,
I think you look at other countries too, Venkat, in Europe, and I think a lot of those countries, there is a history of a lot of people do rent, they don't buy.
Yeah, exactly. And there's
again, why are we sort of the odd man out in some ways too?
Well, it's the whole great Australian dream, isn't it? That you own your house with a backyard and a dog and 2 kids and whatever else. So I think a lot of it is cultural rather than economic, really, because at the end of the day, you got to live somewhere. Now, in Australia, of course, our superannuation and income distribution system is predicated on owning your own property. So that does create certain problems for when you retire. But as you say, rental should be something that shouldn't be seen as a sort of, it shouldn't be poo-pooed as a second-class citizen option.
Correct. Because it's what you do with what you have left over that's more important.
Exactly. So now we've got to finish this one off by talking a little bit about what might be perhaps the most controversial element of all of this, which is that your main residence, the house that you live in, Alex, and the house that I live in, are entirely tax-free as far as capital gains is concerned. So, you could have bought your house in, 1975, or, well, not 1970. You could have bought your house in 1987. CGT would apply. But because you've had it for all these years, you might have bought it for $50,000. Now you sell it for $5 million. It's entirely tax-free. Now, what do we think about that? What do we think about saying, well, maybe it shouldn't be entirely tax-free? Is there a case for and we're not the first people to suggest this, by the way.
Yes. Well, I think if
What
we
do you
look at
reckon?
this, if we do tax houses, I mean, this could, in theory, complicate it, but you say, okay, let's tax it at a different or fixed rate. So it's a family home. Do we only tax a portion of it for a start rather than 100%? And if we tax a portion, do we tax it at a lower rate, a fixed home tax rate, for want of a better term? And that's one way to address it. And then say, okay, people, I think, would mind if they knew that the money was going to somewhere useful. Where they just say it's a tax grab, they'll never accept it. And I think that it's like anything, with the Medicare levy increment, the increase was to fund NDIS, which was for a good purpose. So again, if you've got to be able to demonstrate, if I'm going to tax something we never taxed before, it's where you and I live, Venkat. Will you prove to me, if I have to pay that tax when I sell, okay, what is it going to be used for? All right, because I want to be happy it's used for some social beneficial purpose to society, not just be wasted by the government and some bloody stupid thing.
That's
so
right.
That's one thing. Yeah, sorry.
And another option there might also be to have that sort of tested for the amount of the gain, right? So you might say anything that's above, say, I'll just pick a number. This is not a scientific number, but you might say if you sold a property for more than, let's say, $3 million, right? Correct. That then, even if it's your main residence, a small amount of tax might apply, so that you're not, you're only applying it to, in today's prices, you're applying it to much more expensive properties than lower properties. But tell you what, though, it's got to be a brave politician who even talks about this in public.
But I think in a way they've already started, because if you look at, if you're a non-resident and you buy and build in Australia a family home as such. When you sell it, remember the buyer has to withhold that 17%, not withholding tax from the property. So in a sense, you're forcing these people that are overseas, that say they have a family home here, supposedly for their family, they still get caught by it. So you could sort of say, well, we can sort of finesse it a little bit and say, okay, let's have this withholding or whatever the percentage. It doesn't have to be 17, to be something lower. And as you said, if it's above a threshold, okay. So again, show me, if it applied to you and me, Venkat, I think we want to know, show me what it's going to be used for, not just the general waste of money that governments tend to do.
That's true.
The other option is look at what the US and other countries do. Some countries do tax the disposal of a family home, but they do allow you a certain proportion of your interest cost to be allowed as a deduction.
That's another option, isn't it?
You can sort of mix the two or come to something. But as you said, the key point, Venkat, is I'm a politician. Nobody loves me. I want to be, I want to be re-elected next year or whenever. I'm not going to do something to rock the apple cart.
No. But certainly I think that one that we don't talk about is, of course, the main residence, and, some form of reform in that area is really going to be long-term beneficial. There's no doubt about it. And while it might feel like a bitter pill to swallow, as we've discussed, every other CGT asset is taxed. We only choose not to tax the main residence. But
if you think about it, we already tax what we call collectibles. That's your jewellery. You think, what the hell? I sell jewellery. I got to pay tax on you.
That's right.
So if you're you opened up the gate in this concept of personal use assets and so forth. So we are taxing already personal things. So it's not usually difficult to extend it to the home. And if you look at our tax systems like GST, the more exemptions you have, the more complex it is.
Correct. But again, I guess the counter argument for the main residence CGT is to say that look, shelter that we talked about before, housing is shelter. You need some kind of housing, and that should be exempt. But again, I think that the reality of the situation is not all houses cost the same. And so from that point of view, there should be some kind of logic around, how do we tax this? So very interesting topic. I think we've got a lot coming up in the next couple of months, and you would hope that there's some kind of change comes about. But we'll wait and see what happens, and we'll see if we actually get any change on CGT.
I think, if there's changes, they might say yes, but they'll delay it given what's happening around the world, so to speak, at the moment.
Most likely.
It's typical. I'll hedge my bets. I'll tell you about it now, Venkat, but I'll give you a year to think about it.
It'll probably have a sunrise clause, as in it'll come into effect in some time in the future.
But it's got to be before or maybe after the next election. Because the next elections were about 25.
It's probably only about a year and a half away, I would think. So
24. I wonder whether the last election was about 20.
we had it 24, I think.
Yeah,
so it's only about a year and a bit away. So it's not a long way away.
Yeah, so they might say we'll come to it after the election, so therefore they won't bring anything before, because then they'll lose votes. So
that's right. Well, let's hope for the best, and let's see what happens in the next few weeks as we wait for the budget. Thanks, Alex, and we might just leave it there.
Thanks again, Venkat.